Good morning everyone. Today I will show you how to calculate break-even point, level of sales required to generate target profit and margin of safety. We are given selling price per unit, variable cost per unit, fixed cost, and we have to identify and calculate break-even point. Formula for break-even point is fixed cost divided by contribution per unit. Contribution per unit is selling price per unit minus variable cost per unit. We arrive at contribution per unit. For example, selling price is 28 pound in question 1. Variable cost is 17 pound per unit. When we deduct variable cost from selling price, we get a contribution of 11 pound per unit. At selling price of 28 pound per every unit is not only recovering variable cost of 17 pound but also contributing 11 pound towards the fixed cost. Fixed cost given to us is 1.1 million. We have calculated contribution per unit, which is 11 pound. Formula for break even point is fixed cost divided by contribution per unit. We will divide 1.1 million by 11 pound. We get break even point of 100,000 unit. At this level of sales, we make no profit, no loss. Likewise, if you look at question number 2, selling price per unit is 16 pound, variable cost per unit is 88 pound, contribution per unit is 8 pound, selling price minus variable cost is contribution per unit. Fixed cost given to us is 40,000. In question 3, selling price per unit is 80 pound, variable cost per unit is 25 pound. Every unit is contributing 55 pound toward the fixed cost. In question 4, selling price per unit is 83 pound, variable cost per unit is 65 pound. Every unit is contributing 18 pound toward the fixed cost. In question 5, selling price is 40 pound per unit, variable cost per unit is 28 pound, contribution per unit is 12 pound. We are given a fixed cost of 250,000. Now we will replace fixed cost and contribution per unit in break-even formula. Formula, as you can see, is fixed cost divided by contribution per unit. Fixed cost is 1.1 million and contribution per unit is 11 pound. When we divide 1.1 million by 11 pound per unit of contribution, break-even point is 100,000. Likewise, in question number 2, our fixed cost is 40,000. Contribution per unit is 8 pound. When we divide 40,000 of fixed cost by 8 pound per unit contribution, we get break-even point of 5,000 units. In question 3, fixed cost is 110,000. Contribution margin is 55 pound, as you can see here. We divide 110,000 fixed cost by 55 pound per unit contribution. In question 4, our fixed cost is 540,000. Our contribution per unit is 18 pound. We divide 540 by 18. In question 5, fixed cost is 250,000. We divide 250,000 by 12 pound per unit. You can see we have break-even point sales for each question. 100,000 is for question 1. Selling price per unit is 28 pound. Now we will prove whether we have calculated break-even point right or not. As you can see, after dividing 1.1 million by 11 pound per unit contribution per unit, we get a break-even point of 100,000. When you multiply 100,000 by selling price per unit, we get sales revenue of 2.8 million. Likewise, we multiply 100,000 break-even level by variable cost of 17 pound. When we multiply 100,000 break-even sales level by variable cost of 17 pound. We get variable cost, total variable cost of 1.7 million. We deduct variable cost from sales revenue of 2.8 million. Total contribution is 1.1 million, and from 1.1 million contribution we deduct fixed cost of 1.1 million. You can see profit is 0. Now we will do the same for question 2. Our break even point is 5,000 units. Selling price per unit is 16 pound. When we multiply 5,000 by 16, we get 80,000 sales revenue. We will multiply 5,000 break even point by variable cost of 8 pound per unit. We get 40,000. We deduct variable cost from sales revenue of 80,000. Contribution is 40,000. Total contribution is 40,000. We deduct fixed cost from the total contribution. We can see that the profit is 0. In the same way, break even point for question 3 is 2,000. We multiply 2,000 by 80 pound per unit selling price. We get sales revenue of 160,000. Variable cost is 2,000 units multiplied by 25 pound per unit variable cost. We get total variable cost of 50,000. We deduct it from sales revenue of 160,000. We get total contribution of 110,000. Our fixed cost is 110,000. We get a profit of 0. In the same way, we have a break even point in our question 4 of 30,000 units. Selling price is 83 pound per unit. We multiply 30,000 unit by 83 pound per unit. We get a sales revenue of 2.49 million. We multiply 30,000 unit by variable cost of 65 pound per unit. We get a total variable cost of 1.95 million. We deduct variable cost from sales revenue. We arrive at total contribution of 540,000. We deduct fixed cost of 50,000, which is given in our question. We arrive at 0 profit. In our question 5, our break even point is 20,833 units. We multiply it by 40 pound per unit selling price. We arrive at sales revenue of 833. Okay, we multiply break even point of 20,833 by variable cost of 28 pound. We arrive at variable cost of 583k. We deduct variable cost from our sales revenue. We arrive at contribution margin of 250,000. We deduct fixed cost of 250,000. We arrive at a profit of 0. This is how we calculate break even point. Break even point is the level of sales where sales revenue is equal to total cost. Now we will calculate level of sales at which we not only recover the total cost but also generate given level of profit. In this question again we have 5 different questions. We are giving selling price per unit. For each question variable cost per unit is given. We can see contribution per unit for question 1 is 4 pound. Selling price minus variable cost is 4, which is contribution per unit. Fixed cost is given as 200 pound. Our target profit is 100,000. Every unit at sale price of 10 pound per unit is not only recovering variable cost of 6 pound but also contributing 4 pound toward fixed cost and target profit. Formula for calculating activity level at which we not only cover cost but also target profit is fixed cost plus target profit divided by contribution per unit. As we have already calculated, contribution per unit is 4 pound. fixed cost is 200 pound, target profit is 100 pound, which is 300 pound. 300,000 divided by 4 is 75,000. At 75,000 units of sale, we are not only recovering full cost but also making a profit of 100,000. Let's see if we have calculated right level of activity. We have 75,000 units. Selling price is 10 pound per unit. When we multiply 75,000 by 10, we get sales revenue of 750,000. We can calculate variable cost where level of units are 75,000. We multiply by 6 pound per unit. We get a variable cost of 450,000. When we deduct variable cost from sales revenue, we get a contribution of 300,000 K. We deduct variable cost of 200,000. We arrive at a profit of 100,000, which is our target profit. In question 2, we are given selling price of 28 pound per unit. Variable cost is 19 pound per unit. Contribution per unit is 9 pound. At sale price of 28 pound per unit, every unit is not only recovering variable cost of 19 pound but also contributing 9 pounds toward fixed cost and a target profit. The level of activity, formula for the level of activity at which we not only recover cost but also make target profit is fixed cost divided by target profit. Fixed cost plus target profit divided by contribution per unit. In question 2, our fixed cost is 360,000. We add target profit of 200,000. We arrive at 560,000 divided by contribution per unit, which is 9 pound per unit. Activity level is 62,222 units. We multiply activity level by selling price per unit. We arrive at sales revenue of 1.742 million. Likewise, we will multiply activity level of 62,222 by a variable cost of 19 pound per unit. We arrive at total variable cost of 1.182 million. We deduct variable cost from our sales revenue. We arrive at a total contribution of 560,000, from which we will deduct fixed cost of 360,000. We arrive at a profit of 200,000. You can see which is our target profit. In the same way, in question 3, our selling price is 80 pound per unit. Variable cost is 60 pound per unit. Every unit is contributing 20 pound toward fixed cost and the target profit. Fixed cost given to us is 250,000. Our target profit is 120,000. We add them together. We arrive at 370,000. We will divide 370,000 by contribution per unit. Contribution per unit we can see is 20 pound per unit. 370,000 divided by 20 pound per unit contribution margin. We arrive at target activity of 18,500 units. We multiply 18,500 units by selling price of 80 pound per unit. When we multiply it, we arrive at sales revenue of 1.48 million. Variable cost we can arrive at by multiplying 60 pound per unit by 18,500. We arrive at a total variable cost of 1.1 million. When we deduct variable cost from sales revenue, we arrive at a contribution margin of 317,000. We deduct fixed cost from our total contribution of 370. You can see our profit is 120,000, which is our target profit. In the same way, in question 4, our selling price is 24 pound per unit. Variable cost per unit is 17 pound. Contribution per unit is 7 pound. 24 pound minus 17 pound, we arrive at contribution per unit of 7 pound. Our fixed cost is 910,000 and our target profit is 500,000. When you add them together, we arrive at 1.4 million. As you can see, fixed cost plus target profit divided by contribution per unit. Fixed cost plus target profit is 1.4 million. We divided it by 7 pound per unit contribution. Activity level at which we not only recover cost but make up profit, we generate target profit of 500,000 is 201,429 units. We will multiply activity level by selling price per unit of 24 pound per unit. We arrive at sales revenue of 4.8 million. In the same way, we can calculate total variable cost. Level of activity multiplied by variable cost per unit 17 pound. Variable cost is 3.4 million. We deduct it from our sales revenue of 4.8 million. We arrive at a total contribution of 1.4 million. We deduct fixed costs from our total contribution. When we deduct 910,000 from 1.4 million contribution, we arrive at a profit of 500,000, which is our target profit. In question 5, our selling price is 40 pound per unit. Our variable cost is 32 pound per unit. Every unit is contributing 8 pound toward fixed cost and a target profit. Formula is fixed cost plus target profit divided by contribution per unit. Fixed cost plus target profit is 30,000, 300,000. 300,000 divided by 8 pound per unit. We arrive at an activity level of 37,500. We multiply activity level by selling price of 40 pound per unit. We arrive at sales revenue of 1.5 million. Variable cost you can find by multiplying 37,500 units by 32 pound per unit variable cost. Variable cost is 1.2 million. We deduct it from our sales revenue of 1.5 million. Total contribution we arrive at 300,000. We deduct fixed cost from total contribution. We arrive at a profit of 200,000. This is what our target profit was of 200,000. This is how we calculate activity level at which we not only cover our cost but we also generate target profit. Now we will look at margin of safety. Margin of safety is the difference between budgeted sales and the break-even point. We have 5 questions in front of us. Budgeted sales are given to us. In question 1 it's 70,000 units. Break-even sales also given to us is 50,000 units. Difference between budgeted sales and break-even sale is 20,000, which is our margin of safety. In other words, at this anything above 50,000 we are making profit. If our break-even sales, our sales level drop below break-even sales, then we will make a loss. Any level of activity above break-even point, we will make profit. Margin of safety in this case in question 1 is 20,000 unit. The way we arrive at margin of safety in unit is sales, budgeted sales minus break-even sales. In question 2, budgeted sale is 90,000 units. Break-even sale is 75,000 unit. Margin of safety in unit is 15,000. In question 3, budgeted sales is 100,000. Break-even sales is 80,000. Margin of safety in unit is 20,000. Likewise, in question 4, budgeted sales given to us is 120,000. break-even sales is 90,000. You deduct break-even sale from budgeted sale. We arrive at margin of safety of 30,000 units. In question 5, we are given 150,000 budgeted sales. We deduct break-even sales of 100,000. We arrive at margin of safety of as 15,000 units. In order to calculate it in percentage, we have a formula in front of us. Margin of safety in unit divided by budgeted sales multiplied by 100. As you can see, our margin of safety in question 1 is 20,000 unit. We will divide it by 70,000 budgeted sales and we will multiply by 100. You can see margin of safety as percentage is 28.57. In question 2, margin of safety is 15,000 units. We will divide 15,000 units by 90,000 of budgeted sales and multiply by 100. Margin of safety in percentage is 16.67. For question 3, our margin of safety in units were 20,000. We will divide 20,000 units by budgeted sale of 100,000. We will multiply by 100. We arrive at margin of safety as 20%. In question 4, our budgeted sale was 120,000. Break-even sales were 90,000. Margin of safety in unit 30,000. We divide 30,000 by budgeted sales of 120,000 and multiply by 100. We arrive at margin of safety as 25%. In question 5, budgeted sales were 115,000. We deduct break-even sales of 100,000 units. We arrive at margin of safety in unit 15,000. 15,000 margin of safety unit divided by budgeted sale of 115,000 multiplied by 100. Margin of safety is 13.04%, which means sales can drop below budgeted figure by 13.04% before any loss is made. You can also get a question in another way, whereby you will be given budgeted sales in units. As you can see in this question, we have 75,000. You will be given selling price per unit. Here we have 32 pound per unit. Variable cost per unit is 24 pound. You will calculate contribution per unit. As you can see in this question, 32 minus 24 is 8 pound. Every unit is contributing 8 pound toward profit and our fixed cost. Fixed cost given to us is 480,000. We know break even point is fixed cost divided by contribution per unit. In this question we are given break even fixed cost of 480,000. We will divide 480,000 by 8 pound contribution per unit. Break even sales is 60,000 unit. We will multiply you have got 60,000 break even point. We will minus margin of safety in units. As we have already calculated, it is 15,000. When you deduct break even point from budgeted sale of 75,000, we get margin of safety in unit of 15,000. When you multiply 15,000 units by selling price of 32 pound per unit, we get a margin of safety in revenue of 480,000. In the same way, as we have in this question, we are given budgeted sales in unit of 115,000. Our selling price per unit is 28 pound per unit. Variable cost per unit is 17 pound. Contribution per unit is 11 pound. Fixed cost given to us is 1.1 million. In order to calculate break even point, we will divide fixed cost by contribution per unit. Fixed cost is 1.1 million divided by 11 per unit contribution margin, we arrive at a break-even point of 100,000. Our budgeted sales in unit were 115,000. We will deduct break-even point from our budgeted sale. We will get margin of safety in unit of 15,000. When you multiply 15,000 unit margin of safety by 28 pound per unit selling price, we get margin of safety in revenue of 420,000. In question 3, our budgeted sales in units are 2,500 units. Selling price is 80 pound. Variable cost per unit is 25 pound. Every unit is contributing 55 pound toward the fixed cost. Fixed cost given to us is 110,000. In order to calculate break-even point, we will divide fixed cost by contribution per unit. 110,000 divided by 55 pound per unit contribution, we arrive at break-even point of 2,000 units. We deduct break-even point of 2,000 units from budgeted sales in unit of 2,500. We arrive at margin of safety in units, which is 500 units. We will multiply 500 units by 80 pound per unit selling price. When you multiply margin of safety of 500 units by 80 pound per unit, you arrive at margin of safety in revenue of 40,000. This is how you calculate margin of safety. In this video, we have seen how to calculate break-even point, also level of sales at which we not only recover cost but also generate target profit. And the third question we attempted is margin of safety. I hope everyone this video would have given you an understanding of how to calculate budget break-even point, target profit and margin of safety. Have a very good day. Bye.